Hey everyone, it's Kirk here again at Option Alpha, and welcome back for those of you who are watching here, the recording or either live, either way. Today I want to talk about trading large gaps and market crashes because I think this might help out, and it may potentially be coming, maybe, I don't know, just at the right time, because what we're seeing right now in the markets, and I'll flip over my screen here real quick, is we're starting to see a little bit more selling pressure in the markets. In particular, the Russell looks like it's starting to break down into some new low territory. So we'll see where we end up on the day and see where we close. But we're starting to see some pretty good selling across the board. VIX is up almost 20% on the day. So we got a lot more fear in the market than we had previously. And so I thought it was a good time just to talk about gaps and market crashes, market corrections, and how we can potentially trade through those scenarios. So food for thought on this too, and just to kind of like help piggyback on this, we're going to be releasing a podcast here in the next 2 weeks or so that kind of show you all of our statements going through the last market downturn at the end of last year. So we actually traded through that scenario profitably, which was good. It wasn't every month that was profitable, but overall, as we went from basically the highs in September down to the lows at the end of December, whatever it is, I'm looking at my chart right now, we ended up making money during that scenario. So I think the key to doing this is a couple things, and this would be my three kind of things on my checklist here for you guys as we talk about market crashes or gaps. I think the first thing is shortening up duration. So number one is don't trade so far out. And that means that potentially you can pull back on regular stock investments if you have regular stock investments. But it also means just like keeping an eye on how far out you're going. It means maybe not do a 60 or 90-day trade, maybe focus more on the 30-day type trades. And so I think what we generally see during these low implied volatility times, especially the one that we're in right now, is that going further out, you don't really get compensated that much for the extra time that you take. So if you take a 60-day contract versus a 90, you're really not making that much more money going out to 90 days. So just take the 60 or 30-day contract, really shorten up that duration, and that allows you to be more flexible with adjustments and improvements as the markets potentially go down. Number two is cap your risk. So I'm a huge fan during these environments as an option seller. We know that our risk and where we get killed is when implied volatility shoots through the roof and through the moon. So my suggestion would be cap your risk on all your trades. So everything that we're doing right now is 100% risk defined positions. That means that we're going out and we're selling options aggressively. We're still selling calls and puts at the money, but we're buying the cheap out of the money options that really, really give us that risk protection. So if the markets do blow up and they go crazy, we're not going to lose everything. We don't have undefined risk trades on. We have 0 undefined risk trades on right now. So everything that we're doing right now is 100% capped risk. And so I want to show you this here real quick and just kind of show you the idea behind doing this. And let me go to one of the things that we're trading right now, which should help out in just kind of showing you this. Okay, so for example, let me switch this over. I know I'm like all over the place here. Okay, so for example, we're trading on EEM. So EEM is at $42.50. And so we sold a bunch of at-the-money calls and puts. We're trading iron butterflies on this. So you can see these are our at-the-money contracts that we sold. So we sold at-the-money at 42 and 43, which is basically where it's trading. But then we went out on either end, far out, and we bought these options, 5 of them here for a couple cents and 5 here at 38 and 39. So what we're trying to do here, and these are only trading for like 5-10 cents, but they're super, super cheap. And so for us, we're going to get potentially 15, 16 cents in premium on some of these positions right now. And I know that, I recognize that. So we will not make an extra $15, but that sure is going to protect us in case the markets absolutely fall apart, because those $5 options will go to 200 and give us a huge amount of risk reduction on the downside. So that would be my suggestion for sure. And even on like the call side, a lot of these things right now, I mean, markets can crash up, right? So here are the call options on EEM. They're 2 cents, right? 2 cents. So for 2 cents, you can protect yourself by doing these risk-defined positions. So there's a lot of questions I get from people. It's like, why do you do iron butterflies and low implied volatility? It's basically just a straddle synthetic. I'm really trading a straddle. I'm trading the at-the-money positions, selling options, still doing all the basics that we do normally. But then I'm choosing deliberately to go far out of the money and buy really, really cheap protection. Because with low implied volatility, these things are 5 cents, 2 cents, so cheap. It's worth it to do it. Okay, so that's the second thing is please make sure you cap your risk heading into this. And then the third thing is for these market crashes is wear your seatbelt. And I say that in all honesty because, look, if you're driving down the road, you know that there's a possibility some drunk driver could hit you and take you out, right? And the best thing you can do, you can't avoid that person because they're going to hit you, is wear your seatbelt, right? Just like follow all the rules, don't go too fast, wear your seatbelt. And that same logic applies to trading. So wear your seatbelt means make sure you're allocating a lot less money. It means make sure you're double checking position size. I undoubtedly believe that we're going to see people in the next downturn that had way too much on. They were too aggressive with their position sizing. They had way too much capital at risk. I think right now I've got about 15% of my capital at risk, so 85% is sitting in cash, and I'm good with that. I'm cool with that type of allocation right now, because if the market was to absolutely tank and everything that we had, I would lose 15%. So if the market goes down 50 and I lose 15, I can claw back from that. And that's not including the fact that everything that we're trading is uncorrelated tickers. And so what we saw in the last down move, and we'll show this on the podcast when we go through this in the next couple of weeks, but in the last down move, we were trading things like TLT and FXE and XLU and IUP. Like we were trading all these things, and they're all uncorrelated. So they're not all going to crash at the same time. We were trading gold, and that did really well. We were trading FXE. That practically didn't move as the markets crashed in the US at the end of 2018. So even if all of our stuff was to go completely sideways, not everything is going to be a total loss. So if we have 15% of our account allocated and it's in uncorrelated tickers all over these sectors, China, Euro, gold, silver, oil, emerging markets, I mean, everything, not everything is going to absolutely blow up. So that gives us another level of protection. Doesn't mean that it can't potentially hurt. Black swan events are going to hurt for sure. If you get hit by a drunk driver, it's going to hurt, right? Hopefully you don't die, but it's going to hurt. And so these things are meant to kind of help, weather the blow and give you an opportunity to, quickly jump back up and keep trading. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading.